Hello, everybody. My guest today is Haresh Patel. He has a 30-year career which spans entrepreneur startups to leading three public companies. In 2009, he founded his current company, Mercatus, an investment bank focused on renewable energy assets. Today, the software platform serves $450 billion in assets and investments under management for the world's leading energy companies and global alternative investment funds. Haresh, you ready to take us to the top?
Absolutely, Nathan. Nice to meet you.
That's a lot of assets. You get 1% of all of them, right?
Absolutely.
Tell us about the company. What's Mercatus do and how do you make money?
Yeah, so Mercatus is a software platform. We help private equity funds that are investing in renewable energy and power, real estate, infrastructure, anything that's a physical asset. We help them actually digitalize and help them digitally accelerate their world because it's pretty inefficient today in terms of the only way they've really scaled is by throwing bodies at the problem. And with the type of growth that's coming over the next 30 years, which is about $90 trillion, the growth is, they just need the right tool sets to compete and fight in this battle.
Sorry, 90 trillion of where's that money coming from?
Well, that's going to come from endowment funds and pension funds and, various sovereign funds and just the money that's lined up on the sidelines that invest in other asset classes, all lining up to really invest because the whole globe is kind of going through a major restructure of its energy and power grid, moving to a more, carbon neutral, world. And even as if you think of transportation, when you build buildings, are they LEED friendly? Are they eco-friendly? So there's kind of a global build out of that, the infrastructure. And
so why are these PE firms using them? Are they organizing their investments or they're using this to find brand new investments? It's like the Bloomberg terminal for renewable energy.
I would describe it as the modern Microsoft Office, right? Today they do things in email and Excel. Excel is the engine that the entire world uses. It's the best financial product, and it's something that isn't scaling because it's not connected. So imagine, trying to pass around 1.6 million financial models, and these are very, very sophisticated financial models, and you're trying to figure out, how do you make heads or tails out of it? So this is at the end of the day a data collection problem and a data analytics problem, combined with how do you get 50 or 70 or 100 or 1,500 people collaborating around this process, because it's a fairly lengthy diligence and underwriting process, and every step is related to collaboration.
So just to be clear, this is not for like helping these private equity firms find new deals. It's for them like putting pro formas together or collaborating around data inputs on deals they've already done or that are already part of their portfolio.
Absolutely. So think about, I think we've all bought a home or a motorcycle or leased a car, and so if you remember, you put a lot of paperwork together and you submit it to some broker or financial institution or your bank, and then you get 90 days later you get like an approval, and that whole process of analyzing that data that comes in documents goes into some sort of financial model, say is XYZ financeable, and do we want to make that investment? That process is very labor intensive, manual, and error prone, and it's not scaling for the type of dollars that are coming into this marketplace.
Yeah. Okay, so how do you make money?
So we make money as a software as a service business model. So we charge our customers a fee based on the dollars of AUM. So you were tongue in cheek about 1%. 1% would be rich for a software company, but we do make a percent of what we call basis points in the world of financing. We'll make a percentage of basis points on the AUM or the assets under management that the customer will put on our platform. So it's a recurring fee that every year they'll pay a different amount depending on how many assets they have on our platform.
Okay, well, what would you say the average customer pays per year for this?
Our average customer typically pays somewhere between, on the low end, it can be as low as $100,000 a year. On the high end, it can be as high as $8 to $10 million. It just depends. If they're a $40 billion fund, they're going to probably pay us in that very high, $8 to $10 million range per year.
Give me an average. That's a huge range. Give me an average. Would you say that the kind of the perfect cohort or the mean across your customer base is like $1 million a year?
It's half of that. It's about $500,000 a year is kind of what our average is.
I imagine you definitely see power laws where the top 10% of your folks make up more than 90% of your AUM or something like that.
It's the 80-20 rule, right? So there's always a large customer base, but there's about 20 or 30% that make up a vast majority, and that's the way the private equity world shakes out today. There's about 600 customers today in our universe. That 10 or 15 of those are greater than $50 billion a year.
How many of the 600 have you been able to capture? So what's your market share?
So we're still venture-backed company. So we're under about 2 or 3 dozen total global funds. We've taken a strategy much like I would say IBM did in the 80s and 90s. You go after Pepsi and Coke, you nail the 2 big guys, and then everybody else wants to copy them. So we've been deliberate in terms of being very focused, going after some of the biggest global names in the world and making them highly referenceable. And so now we're beginning to see that network effect.
So just to be clear, you've got about maybe 24 customers right now with the possibility to expand to maybe 600 over time.
600 is kind of the first landing spot, yeah.
Okay, but 24 today.
24 today, yeah. And 600 is our total ecosystem. When we apply our pricing to that, and we're actually applying pricing we're getting, not pricing we'd like to get, against that profile of those 600 customers, it's about a $1.8 billion market size for us.
So Haresh, I mean, can I multiply the $500,000 ACV you just gave me times 24? I mean, that puts you at what, like a $12 million run rate right now? Is that about right?
Yeah, that's in that rate range. Yes.
Okay.
Correct.
And talk to me about growth. Where were you a year ago?
So we're in the phase where we're doubling.
Okay, so you're doing about 500 grand a month a year ago.
We've had a good. Yeah.
That's great growth. Where does most of the growth come from? Expansion revenue or new customers altogether?
We get it from both. So we actually get kind of 3 approaches. Obviously, new customers kind of give you that big step up. Our customers are growing because, as we said, it's a growing market. So our customers, if we just leave them alone, grow somewhere between 18 and 25% a year. So we get nice organic growth because they're growing, and so their assets under management on our platform are growing. And then clearly, we try a land and expand strategy. So a large company, that has a global footprint may have actually 30 different teams, investing in different asset classes. So we may land at a particular spot, and we'll close that opportunity. A lot of times, because our heritage started with renewable energy, we start with that group. But then they have a sister real estate group, they have a sister infrastructure group, sister oil and gas, and so we'll begin to expand our footprint. So that's what I call land and expand strategy.
Interesting. And then if you have 18% expansion, that's great. What's your gross revenue churn annually?
The gross churn in terms of how many customers we lose?
No, not a number of customers. The actual revenue churn. So if someone downgrades, you'd have revenue churn, but you didn't lose them as a customer.
Oh, okay. We don't have as much. We have, I would say, our churn is more related to, customers coming to the market and their business goes aground. That's usually what causes our churn. We're not seeing many customers. This is a marathon race right now, and everybody's running downhill. So even the best are actually doing really, really well.
What's your number though, Haresh? Though right now, is it 5%, 10%, 20% annual revenue churn?
It's well under 10% revenue churn for us.
Okay, so 10% revenue churn, 18% expansion. You're at what, over 108% net revenue retention?
Yes.
That's great. That's really great. How are you? Talk to me about your sales model. How are you landing new customers? Do you have an inside sales team or what?
We actually kind of use a multi-channel strategy. Again, when you're trying to do what I call a vertical play, it's a narrow, looking for needles in a haystack. I call it dust of speck in a haystack. We use a combination of a direct sales organization, which attends a lot of conferences where like-minded people come together. That's probably our most rich source of information.
Okay.
But then we do a lot of inbound and outbound marketing, what we call account-based marketing, which is what I would say highly customized. It's not a generic email blast to the whole world, but optimizing it by the customer, by the persona. So that's another part of our marketing approach. We also have channel partners because our customers will reach out to large consulting firms and or specialty firms that help private equity sort through their problems and saying, how do I build my IT stack? So those channels, we educate them so they can recommend us as part of their services. And then we also have a really strong board and advisory network, and those folks are highly connected. So our sale is at a very high level. It's C-level. And so getting those connections are really, really critical. So it's a direct model combined with a variety of different highly optimized marketing.
How many people are on the team?
So our total company size is about 45 people, and about a third of almost 40% of our organization is customer facing, between either the sales team, marketing team, which is, grabbing new customer logos, and we have a whole customer and professional services team that, makes customers really happy so they renew with us.
Haresh, when you take on all their salaries and any direct marketing spend, conference sponsorships, what's your fully weighted CAC to get a new $500,000 a year account?
It's roughly running about $300,000 to get a customer, but we're getting multi-year contracts. So
8-month payback though on the cash.
Yeah, typically that's our cost of customer acquisition.
That's great.
And
where's the team? Go ahead.
Sorry, go ahead. I was saying our average, customer signs us up for 3 to 5 years as well, so they're making a long-term commitment. So it's
But
a nice.
what do they pay up front though in terms of cash? Just a year?
They will pay for, yes, one full entire year in advance. And then typically half of the first year's licensing fee is what's required to provide that configuration, training,
Professional
support,
service.
change management, all the professional services to make them successful.
Where's everybody based? 45 people.
We are a very distributed company. So we're headquartered in Silicon Valley. So about 30% of our employees are here in Silicon Valley. We're about 15 miles shy of San Francisco, south of San Francisco. And then we have a development team in St. Petersburg, Florida. And then we have 2 overseas teams, and we have an office in Italy.
So California and remote. Now, have you bootstrapped this or raised capital?
We started the first couple of years as a bootstrapped organization. Our journey is quite interesting. And then we did, and I'll share with you what our journey is, and then we raised our Series A in 2012, and then we raised Series B in 2015.
So how much total raised to date?
A little over $20 million is what we've raised.
All equity or any debt in there?
All equity.
That's good. Now, so how aggressive are you being today in terms of kind of burn rate? I mean, are you burning capital today or are you cash flow positive?
No, we are still burning. We still have a burn rate, and we're anticipating break even either if the winds are to our back in the fourth quarter, and if we hit a little bit of headwinds or just a few hiccups, which every startup does. Probably, we're targeting right now first quarter. Somewhere between end of first quarter, early second quarter is our time frame.
So when you say burn rate today, I mean, are we talking like $1 million a month, $100,000 a month?
No, it's about three or 400,000 a month.
Okay, so nothing crazy.
It's trending downwards because of just as we add customers, we're keeping our overhead as lean as possible.
And when did you launch the company? What year?
So our journey is interesting. We actually started about 6 years ago as a software company. And we actually were an accidental software company. Our prior business model was actually investment banking. We found an opportunity to actually be a sell-side investment banker for solar projects. And we realized, wow, we had our own Uber moment saying, this is the most inefficient thing. Why do people do it this way? Why do they live in data rooms and spend weekends and Thanksgiving weekend putting together investment memos? Because there's got to be a better way. So we wanted to be the best and we wanted to be the most efficient. So we built a software for ourselves. And as we were shopping projects on the sell side, the same customer said, wow, we love your software. Can we have that? We'd love to buy that from you. That's when we recognized we had a golden product. And so what turned out to be a solar platform turned out to be a very unique architecture because we had no legacy in the way we built the software. So we're able to do any physical asset class. It just happened to be we solved the most complex because solar comes with the dynamics of a large project, but it comes in very high volume.
Interesting.
So today we were shocked when we heard some of the top global private equity firms. They're investing tens and billions of dollars of our money and your grandmom's money and my grandmother's money. They're flying blind in terms of how fast their business is growing. So we're trying to get them organized and get their data in a more centralized place.
Yep, makes a lot of sense. Talk to me about what you want to do moving forward. I mean, any plans to raise capital right now?
Right now, no. I think we're looking to really stay focused. We raised, an internal round late last year. And so it gives us a great runway to really scale the company because we've got really good product market fit. Now it's just, getting customers and making sure we retain and make happy the existing customers. So this is a scale game this year. And so the timing for our capital raise is likely to start in the fourth quarter. And it'll be more about choosing because we'll be cash flow break even by then. But I think we smell a really, really strong opportunity. So if we want to add more, foot to the accelerator, then that's why we would raise the capital.
You're doing about $12 million a year right now. You raised $20 million. I'm sure there's some kind of liquidation preference or something like that in there. If someone came and offered you like $67 million, $70 million to sell the company, would you sell?
We had that offer and we said no.
Who and why'd you say no?
Well, I think that when you look at the market potential, right? You've got we're still early in our maturity as a company. When we were able to actually get some of our customers to have real definitive proof points, the leverage of our pricing will be significantly higher. Also, when we're at this stage, a software company will get 6.5 to 8 times multiple on average, and if you're well above average, you can get almost 20 times revenue. And so when you look at a $1.8 billion market, if you're where we're at today, and you think you've got a shot at getting to $100 million, there's a significant multiple that can be had that could be a more substantial exit. So exits that have gotten us excited are other vertical plays. One is Viva Systems. They did a vertical play selling to pharma.
Yep.
And their customer is actually no more narrow than ours was. and they had a nice $1.8 billion IPO. Adaptive Insights just got acquired by Workday, and they were doing the same kind of financial modeling, planning, and budgeting, revolving around the financial model like we do. And they were acquired by $1.3 billion. So we just see significant, upside potential, and it's a little early.
Very good. Let's wrap up quickly with the famous five. We're out of time. Number one, what's your favorite business book?
Well, that's my favorite business book. I would say it was one that I read really early in my career because it gave me my career goalpost. It was Lee Iacocca's book. And this is when he was the rock star, much like Tim Cook is today, when he was turning around Chrysler. And, it inspired me because I was about 4 years out of college, and I didn't have a goal, and I was flying to corporate for some business meeting, and I read his book. In his first chapter, he set his goal on the day one of out of college when he was working for Ford. And he saw a bunch of vice presidents and said, you know what, I'm going to be VP like that by 35. And so I borrowed his goal, and I hit my goal as well of being a VP by 35. So I like the book. There's certainly better books out there than that, but I like it because it had a lot of personal meaning to me in terms of how I was able to shape my career.
Very good. Lee, number two, is there a CEO you're following or studying right now?
I would say that I really like historically what Steve Jobs Apple. I like Airbnb and Uber are doing to their business. It's the disruption that you can create.
Great. Steve
by solving
Jobs.
a problem.
Number three, what's your favorite online tool right now for building the company?
Online tool for building a company. I would say that it's probably at this stage a collage of 2 or 3 different pieces of software.
Just pick one you use the most.
We probably use Salesforce the most.
Okay. Number 4, how many hours of sleep do you get every night?
The good question. Probably about 7 is my average.
That's good. And what's your situation? Married, single, kids?
I am married. We celebrated our 30th anniversary last year.
Congrats.
In August.
How many? Any kids?
And we have 3 children. So 28. Daughter lives in San Francisco, son 26 lives in San Francisco, and we have a 16-year-old straggler that is, so we're preciously holding on to her before we become empty nesters.
Very good, Haresh. And how old are you?
I am 57.
Last question. What do you wish your 20-year-old self knew?
I'm sorry, say that again?
What's something you wish you knew when you were 20?
Oh, what would I know when I was 20? I would say that, business is a journey, and, count on ups and downs and don't let yourself get down. So I think had I known that, I wouldn't have spent as much time. But as I see other entrepreneurs, I just see that, some of the most successful ones had some really interesting roller coaster rides where that bottom of that roller coaster was almost a full nosedive.
Very good, guys. Mercatus launched back in 2012. Now 24 private equity clients paying him, again, to manage their pro formas, their diligence, you name it, data related to their deals. These private equity firms have over $450 billion in assets under management. He prices against that, so doing about $12 million today in ARR. That's up doubled year over year from about $6 million in ARR, again, just a year ago. $20 million raised, burning about $400,000 per month right now with an eye to profitability by the end of Q4 2019 before they start their next raise. 45 people in California and remote, 10% revenue churn, 18% expansion annually. So net revenue retention, 108%, spending maybe $300,000 to acquire customers with an 8-month payback period. Haresh, thank you for taking us to the top.
Thank you for the time. Appreciate the opportunity to speak with you.